And if you look forward the next 5 years, the U.S. is really it, right? I mean, the U.S. is such a phenomenal powerhouse that we think it provides the majority of what the new growth that's required going forward over the next 5 years or so. And I'll show you a little bit more about where that's coming from and some of the risk factors around around that forecast. Because as I said, put on the title slide, I want to provide a balanced view here. And so what you'll hear today is a lot of positives, and then there'll be some realities in terms of demand growth and things that. So I want to put this in the context of both the up and down side. So next slide, please. So this is the history and the outlook at a very high level for the U.S. Crude on the left, gas on the right. And you can see there, the phenomenal growth really coming out of what was essentially a flat declining crude market prior to about 2010. The pop-up that we had up through 14, a little bit of a decline with the price collapse, but then really finding those efficiencies out in the oil field and back on a growth trajectory. We have the U.S. in our balances growing to about 16 million barrels a day by 2025 timeframe. It does stabilize around that level going forward, in our view. Still a lot of resource in the rock, but as I'll show you here in a minute, the treadmill that we're getting on is quite extraordinary. I'll come back and talk a little bit about gas in a couple of slides. So next slide, please. So one of the factors that has really been affecting the drillers out in West Texas and even up in the Bakken and other areas is takeaway capacity, right? It's really the infrastructure that were needed to get those resources out, and it's not uncommon that the production sometimes gets ahead of the building of those pipeline systems. The good news is we've got those pipeline systems on now or coming online over the rest of this year that'll really provide that relieve that constraint, if you will, really for the foreseeable future, and really don't see visibility on when those constraints come back in. So what that means is that the drillers in West Texas are getting as good a price as they can get shipping that crude through the most efficient, low-cost transportation mechanism. We will get the pipes eventually from Canada. That's a question as well, and one that is continually being held up by different regulatory constraints. Our view is that those will get worked out, and that we will have the ability to bring more heavy crude down, run it in the Gulf Coast refining system, which is particularly well suited, for the heavier Canadian crudes. The other thing I would say is we need to build some infrastructure to export crude oil out of the U.S. And by that, I really mean some of these deep water, either deep water ports or offshore loading facilities to where we can load VLCC, fully load VLCC capacity, which really, again, provides the most efficient modes of transportation, gets as good a price as possible back to the producer at the wellhead. And we do think a lot of the U.S. crude oil will go offshore. A lot of the growth from here in that growth wedge probably does go offshore, mostly all the way to Asia. Next slide, please. So this is what we call the fishbone chart. It's a very colorful piece of art, but it tells a very important story, and that is that treadmill, right, the amount of base decline rate that we are experiencing in the U.S. tight oil fields continues to grow, right? And so, these new wells that you drill are very prolific in the first opening months, but they have very sharp decline rates in the first year or two or three. They eventually kind of stabilize, and you do get a bit of base production, and the well lasts several more years. But it's that steep decline rate that means after you drill that well, you've got to come back next year and drill, another well. For every 2 or 3 wells you drill this year, you got to go drill another well next year just to replace that one So to actually maintain a stable production level, you've got to drill to replace the base decline, which is what's on the bottom. This is really the negative bars on the bottom of the chart here. And you can see them stacked up by month. Those are essentially months for the year. And so if you look at those numbers on the very bottom, you can see there that in 2017, 2018, we needed to replace about 2.5 million barrels a day of decline rate, right? And so in 2018, we had phenomenal growth, right? 1.3 million barrels a day of entry to exit growth. But that was really because we had 3.3 million barrels of oil wells coming online, offset by 2 million barrels a day of decline. And so when we do our math and we're thinking forward and developing a forecast, what we see is that decline rate gets steeper and steeper and steeper as we have more and more production, and that production is based out of young new wells. And so we eventually get to a point where we think those declines largely offset the growth, and so your wedge volume largely is offset by declines. And so that's why we top out around 16 million barrels a day. U.S. is still the world's largest crude oil exporter or crude oil producer at that point in time. So still a very phenomenal story. Next slide, please. So the Permian is the primary success story here. There's a lot of resources up in the Bakken. There's resources in Niobrara. But where the most prolific, most economic are in the Permian right now, and so that's where the independent producers are really putting a lot of their activity and a lot of their drilling efforts. So this really just kind of stacks up and shows you, where that growth is coming from by different plays and how that stacks up. Next slide, please. So again, I said I was going to give you a balanced view, right? So the reality is that a lot of the production gain, the productivity gains that we've seen in the tight oil plays are starting to fade. And what this chart here shows is really how quickly we've been able to get that initial production on. And so the steeper that line is vertically, the closer, the slower the productivity gains, that we've got. And so we are approaching something that is appears to be stabilizing, right? Now, technology and innovation continues to evolve, and maybe we find something else. But a lot of what we've been doing to improve productivity by well is longer lateral lengths, higher proppant production rates, and understanding the interference and well spacing. We're starting to get that figured out, so we get to take advantage of that going forward. But any gains by doing other improvements may be fading to a degree. I'd say the other thing that's interesting to think about and we're keeping a close eye on is as you bring the major oil companies back into the Permian, they will bring a scale, a focus on efficiency, and a manufacturing base that is not available to many of the independent producers that have really created this revolution in the first place. So, efficiency and scale and cost control, right, will be brought to bear even more so as you bring some of those major oil companies back in there. And that's we take that into account, but that's a key factor. So next slide. So the other thing about the upstream, and then I'll move on and talk about some of the other stuff, is Wall Street's pretty mad at them. Right? Wall Street is not very happy. The investors are not very happy with the independent crude producers because they've not been that profitable and they've not been giving anything back. And so the real modus operandi today for the independent producer is discipline, right? Cash flow discipline and pay down the debt and give some cash back either through dividends or stock buybacks back to the investor. And you can see here, I've got 3 different cases. Our base case assumes about 10% of that cash flow that's generated in our forecast for those independents go back to the investor, and that gives you one production profile. If those assumptions are wrong or different going forward, if they give more back, 20% back, you get that lower line. If they go back to zero, which is largely where they've been, matter of fact, they've been negative for, through much of 13, 14, they were actually negative. They were outspending cash flow. But if you essentially take all their profits and put it back into the drill bit, you get that purple line, right? So there is upside here, but right now our thinking is that based on the strategies and the statements from the oil companies, they've got to give some of that money back, which is slowing some of the growth, but ultimately may be good for the industry. Next slide, please. So I need to make a comment or two. I've been quite busy since Saturday, as you might imagine, being an oil forecaster. I'd say the question I have really is what happened in Saudi Arabia and the market response to that. Is that understated? This was one of the largest disruptions ever to oil infrastructure and production, right? But it was fairly muted, right? Price went up on Monday, came back down, it's back down again today. All the conventional wisdom in the news is this is handled, it'll be sorted out, not a big deal. The focus is really on the weaker demand growth that we have, the U.S.-China trade war, and other factors, right, that are muting the price response. I'm not sure that's right. I'm not sure that we're not fully reflecting everything in here. There's only about 1 million barrels a day of spare capacity outside of Saudi Arabia. And it's a 1 million barrel a day market, right? So you got 1% outside Saudi Arabia as cushion, right? Saudis are cutting refinery runs in order to supply those, to supply the export and meet their crude export commitments. At this point, the timing of the restart and the repair of the damage is still unclear. We don't have any certainty around that. And those of you in the audience who've been involved in repairing damaged equipment know it takes time, right? It takes time just to do the assessment and to start thinking about ordering the equipment, let alone install it and get it back online. So our initial price forecast thinking on this is that prices go up from here, right? That this hasn't all played out yet, and that we'll have higher oil prices as the situation becomes more clear. And of course, one thing that'll do is stimulate some of those production numbers on that chart I showed you before. So the situation remains pretty unclear to us at this juncture. So next slide. Next slide. So just a little bit on gas markets, which is another phenomenal growth story in the U.S. Of course, those of you that follow the industry, we really perfected and created the initial innovation in the gas space in terms of shale gas, horizontal drilling, and high-pressure water fracturing. You can see there we've got fairly substantial production growth. Most of that's coming really from two plays in the U.S. plus a little bit that Montney there is up in Canada in Alberta. Associated gas, a lot of that's from West Texas, the Permian, and then Appalachia, right? So those are the two big areas. We've got tons of gas, right? And we've got decades and decades of gas. These just happens to be where the most economic gas is right now. Next slide. So the gas market, though, is somewhat demand limited. You can see that we've put a lot of that gas into the power sector initially. As the power sector brings on more renewables, wind and solar both, we'll see that growth in the gas into power start to decline. And more of the gas demand will shift into the LNG exports. So as we bring on these LNG export facilities, I'd say those facilities in the grand scheme of things are limited by the demand, right? The global demand for LNG into these developing economies is really what's limiting. And there's some real competitors in that space. You got Qatar coming back with additional supply. You've also got cheap supply out of Australia, now out of Eastern Africa. And so there's a lot of gas out there. The U.S. can be quite competitive, but they've got to compete into that market. Next slide. And so, what that's done for the U.S. consumer and petrochemical refining industry is create phenomenally low gas price. And you can see here kind of gas price across 3 different eras, right? So you got the pre-shale era. You've got an era, we call gassy shale gas. That's really the period of time when we were producing shale gas out of, mainly shale plays just for gas. And now you've got the period of time where the price of that gas is really being set by associated gas out of the Permian. And so we're talking $2 gas, right? That's real competitive on the world stage. Creates cheap energy, creates cheap hydrogen for dehydrogen processing in refineries and so forth. It probably won't stay at $2. We're probably looking at 3 or maybe even 4, 10 years from now. That's still quite competitive. Next slide. And so, I'm not going to talk about, just in the interest of time, on petrochemicals, but that's where a lot of the investment and a lot of the benefit from the gas side has really come from. And it's really this gas-oil spread that's created that advantage, right? That, particularly in the olefin side of the business, that the world's olefin supply and olefins pricing is really based off of naphtha based crackers, largely in Asia and Europe, and that that naphtha is really priced off of crude. And so whenever you have high crude relative to gas, that provides the opportunity to upgrade, ethane that is is priced around gas plus, has really created the economic driver, the financial driver that's created a lot of the billions of dollars of investment that are going in right here in the Gulf Coast. Next slide. So the other thing that's done is it's stimulated, and created NGL supply. And NGLs is a very interesting market. If you look at the growth rates, NGL growth rates are far exceeding either the growth in crude oil or the growth in natural gas production in the U.S. since, say, 2010. And that's really because both the wet gas plays that we are creating in Appalachia, plus this light crude oil, both of them have a lot of associated NGLs, and so that's created a huge uptick in NGLs, and created the need for export infrastructure as well as the ability to use those as low-cost petrochemical feedstocks. And we're exporting, of all things, ethane from the U.S., which would have been just laughable 5 years ago, right? Nobody in their serious mind, or 10 years ago for sure, would have really thought we'd be exporting ethane. Next slide. And then propane is the other one I'll show you. Demand for propane in the U.S. is fairly stable. We're building, there's a few propane dehydros and a few applications for it, but the vast majority of that's going to be exported. It just so turns out that because of these light feeds and because of the need for propylene plastics in China, that China is building a lot of propane dehydros and importing a lot of propane. And so guess what, right? We find ourselves in this interesting position, geopolitical tensions between our governments, but the trade needs of our industries are symbiotic. China's not importing any of our propane right now. They've shifted over to the Middle East, and so our exports are, at least for now, have shifted into other Korea, Japan, other markets. But, ultimately, assuming the trade dispute gets resolved in some way, there's certainly a relationship there. Next slide. Next slide, thanks. So, this is a topic, energy transition, that probably doesn't get enough play in this part of the world, right? Because of who's in the White House and because of the industry that we've got here, So one of the things I get to do is speak with a lot of our industry leaders globally, right? So I spend a lot of time in the Middle East, in Asia, Europe, India, Africa, Latin America. And so the one thing I'd say is that the energy transition and the way that business is thinking about this is really more advanced than it is here in the U.S. And we do think it's coming, right? We do think there is an energy transition. We will have electrification of some of the transportation sector. We will have some other decarbonization steps and efficiencies in other parts of the sectors that I'll talk about here in a minute. There is the key question of the pace of that change and how quick it happens. But some of the technologies and some of the policies are getting quite advanced. And for one of the most advanced, right, you have to do nothing more but look to our West Coast. California probably certainly does have some of the most advanced policies, along with Europe. And so as they implement those policies and as the capital and technology get deployed, some of those benefits, will be available to other industries. So we'll see how this evolves, right? Again, I think in many ways, what I see is that our industry here in the U.S. is not really forward-thinking enough on some of this, but that's somewhat open for debate, I think. Next slide. There is no, I don't want you to take away that there's not a need for transport, right? There actually is a huge demand growth for transport of people, of goods, around the world. So what I've shown here, really, this illustrative chart is, part of what we do is we forecast trade and movements, right? And so I've got here those 4 lines. One is light-duty vehicle passenger miles globally. One is passenger seat miles on aircraft. One of them is truck ton miles, and the other is waterborne trade ton miles. And you can see that historically, I've just set them on an index of 1.0 in history, and I reset that index in 2018. So those are just relative growth rates. So there's no shortage of demand for mobility, effectively, right? It's really the efficiencies and the decarbonization of the fuels that will have the most impact on us. Next slide, please. So a little bit of numbers. The chart on the left is new vehicle sales globally by powertrain. Okay, so we build all this up from the bottom, looking at the various policies and cost structures, and we've got a view that batteries, the lithium-ion battery does get a bit more efficient. So we do have, in order to meet the economy standards around the world, CAFE here, CFAC in China, the European standard, the OEMs, the automotive manufacturers, are creating plans and installing production lines, right, to make more hybrids. Some batteries, I think in many ways what we see are the OEMs are hedging their bets a bit on battery. They're going with hybrid models, knowing that those are accepted by consumers, and then if consumers accept the pure battery or the plug-in battery models, then you'll see them shifting that way. But this is really what's required, along with some light weighting, along with some efficiency gains in this gasoline traditional ICE engines, to really meet those fuel economy standards. And in a lot of ways, those fuel economy standards are less risky in some ways in the forecast than things like battery cost technology. I'd say the other thing, though, is this is all started in the light-duty sector, and that's the one we understand, and that's the one that gets all the headlines that, Porsche's coming out with, the next battery, 911, so on and so forth. But, the trucking sector, the U.S. now has a efficiency standard for trucking, heavy-duty trucking. The first time, really. It's been in a few years, but it's just now really starting to take hold. Europe, Japan, China also have truck efficiency standards. The IMO, many of you know about the IMO 2020 and the impact on bunker fuels. But the IMO's also come out with carbon reduction targets that will challenge the industry. There's a lot of inefficiency in shipping, so there's a lot that could be done with slower sailing, with smaller engines, better operations, better scheduling, and so forth. But ultimately, there may need to be some different technologies and different fuel options in the shipping fleet. And then the real challenging one's aviation, right? So you've probably read a little bit about the flight shaming that's going on in Europe. So we're starting to see some of the some trends around the awareness, the public awareness around the amount of carbon that's emitted from the aviation sector. And the aviation sector is one of the fastest growing transportation modes, right? So it's a real challenging one, right? It's one that's very hard to decarbonize outside of biojet. So just something to keep an eye on, and we're doing a lot of work in this space. A lot of these are long-term trends. Don't have to worry about it next quarter or the quarter after, but they're longer-term trends. So next slide. So this is the U.S. This is our outlook for the U.S. And again, all willingness to stand up here and give you both sides of the view. We do think the U.S. oil demand, refined product demand, does go into decline. That's primarily because of the CAFE standard that I think was mentioned on the prior panel. Electric vehicles have some impact on this, but the 80-20 rule of this chart is fuel economy standards in the automotive sector, and to a lesser degree those truck standards that I just mentioned to you, right? So next slide. Not all is lost though, right? What's really happened is we've integrated the North American refining system and product markets with Latin America for a number of reasons. We've had Latin American countries on whole have not been able to keep up with their investments to meet their demand, and so they've become increasingly reliant on imported product, most of that coming out of the U.S. And so we continue to see that going forward. Each country's got a bit of a different situation, and there's a lot of political uncertainty, political risk in our forecast, particularly in countries like Latin America. But it does seem to us that trade is becoming somewhat structural, and it does offer an opportunity for U.S. refiners, which are, I think, also as was mentioned, very efficient, very effective, low-cost crude, low-cost gas, and so forth. So we do see the U.S. Gulf Coast refining system being very competitive, right? They can essentially place product anywhere in the Atlantic Basin and compete, and at times, may be able to even go farther afield and stay competitive. Next slide. So I'll just close with a few thoughts, and then if we got time, I'll take questions. Happy to have a bit of a dialogue. The U.S. crude and gas has created great economic benefits, and those benefits really go beyond Texas, right, or North Dakota or Louisiana, right? The supply chain factor. So when we did our work for the crude oil export study a couple of years ago, we did an industry study, and we tied up with our economics team, so back to IHS capability here, and we essentially took our energy modeling and investment and worked with our economics team, who then modeled the supply chain. And what we found is those supply chains are long and they're real, and they go to all states in the union, right? So the manufacturers in the Midwest are benefiting from the investments and the activity that's happening, closer here to Houston, Texas. And that's not as you all know, that's not well understood, right? It's not well understood by the common man. It's not well understood by, many of our own families. So we got to continue to get that message out. Also, as I travel the world and talk with, again, leaders of the industry, I continue to find that the U.S. is one of the most efficient, effective have some of the most effective businesses around, right? Even though the cost structure is higher in terms of, what you pay for an engineer, what you pay for a welder, and so forth, the ability to make business decisions, the efficiency of the capital deployment, and the reactivity to price signals here, be it in the wellheads or in plant investments is pretty extraordinary, right? And not matched. The Chinese do a lot. They do it. They're quite fast at doing things, but they're not particularly efficient, right? There's a lot of wasteful capital and a lot of waste in the system. So clear, consistent policies and regulations. There's people here on stage that can speak much more to that than me. But I think the energy demand, will go through a transition. We will see policies that continue to work to decarbonize the energy mix. The pace is the key question, but I think the U.S. really has an opportunity to lead in a lot of those places with wind and solar and biofuels and other ways. So it's not all a complete negative. But all that said, hydrocarbons, in our view, even in our most optimistic view, if you will, for policy and technology advances in decarbonization, even in those more extreme scenarios, hydrocarbons have to continue to play a role to meet the world's energy needs. So with that, I'll pause there. So see if I can read these questions quick enough here. Yeah, so questions here around the infrastructure challenges, right? And I think it kind of goes back to what I was saying about regulatory certainty, right? And having the ability to know what the rules are, right? And that the rules that you're making those decisions today in are the same rules as that project progresses, right? And as it operates, right? And so I think, from an infrastructure point of view, near term, what we're seeing is the constraints that we had in the pipeline systems are being relieved, right? Those constraints have kind of started to move into the terminals and tanks, right? And then eventually they'll move kind of into the waterways and the export pipelines. Speaking of crude, right? So I think that's where the infrastructure really needs to be put in now is the efficient moving of crude oil offshore. And again, I think our view is that there will be some refining expansions, debottlenecks to run more tight oil, but we're not sure there will be big grassroots refineries built on tight oil in the U.S. largely because of those demand trends I was showing, where you're essentially investing for an export market, which is difficult to do. So we'll debottleneck. We'll run the equipment we have. We've run record high utilization rates in the refining system, particularly here on the Gulf Coast. So a question about petrochemical exports and destinations, for China. So what we are seeing broadly, right, is switching of trade flows, right? And I think LPG is a prime example, right? So LPG trade. We had a large trade flow from the U.S. into China, and there's a large trade flow coming out of the Middle East of LPGs that was going, say, into Japan and Korea and some into China. When the tariffs first got put on propane, and they got put on a while back in one of the early tiers of the tariff war, if you will, we immediately saw, exports of propane to China, U.S. to China stop, and those started to flow over into Korea and Japan. So we didn't see an impact in U.S. export trade. And we saw the Middle East supplies that were going into, say, Korea and Japan shift back over to China. What we did also see in the numbers, right, if you look real hard at the pricing centers, the 2 or 3 different pricing centers that we have transparent pricing on, is the Chinese ended up paying about $20 a ton more for propane as a result of that shift in the trade flows, right? But that's far less than the 10-15% tariff. Similar things will happen on petrochemicals as well, right? Where you'll see those trade flows shift around, which is adding inefficiency into the system, but it is reacting in a logical way. So any other questions? I think those are, unless I'm missing any others. All right. Thank you.